Introduction, Understanding Ancient Roman Banking. The concept of banking has evolved significantly over time, but in ancient Rome, the systems in place were surprisingly sophisticated for their era. While today we enjoy the conveniences of a cashless society, our ancestors had to address crucial questions related to currency storage, managing large transactions, and transferring money across long distances. The ancient Romans had their own answers, developing a banking system that featured both public and private institutions, regulated loans, money exchanges, and even a form of credit and debit that allowed for virtual transactions across the empire. Despite its innovation, Roman banking, like modern systems, faced numerous challenges, including tension between regulation and risk-taking, which led to financial crises. Footnote: Ancient Roman banking was surprisingly modern, involving both public and private institutions, offering services such as money exchanges and regulated loans. Origins of Roman banking, early development and its role in society. Introduction to Roman banking. Roman banking began in an era when bartering was still common. A farmer, for instance, might trade goods directly at the market, but as Roman society grew and commerce expanded, the need for a more efficient system became clear. By the 4th century BC, Rome adopted coinage, allowing individuals to exchange currency instead of goods. This facilitated larger transactions and greater ease of trade, but it also created a need for secure places to store and manage currency. The role of temples in early banking. Initially, the temples of Rome served as rudimentary banks. These structures, which already housed treasures, were naturally suited to store and manage money, as they had both a staff of trusted individuals and were patrolled by soldiers. Over time, these temples began to offer banking services such as currency exchange and loans, with records meticulously kept of the transactions. This was the beginning of what could be considered public banking in ancient Rome. Footnote: Roman temples acted as the first banks, storing currency and offering rudimentary financial services to the public. The rise of public banking institutions, the creation of quinquerimentiari. Government intervention in banking. As Rome's economy grew, the state recognized the need for a more formal banking system. Evidence of this comes from 352 BC, when the debt crisis among plebeians led the Senate to approve a special commission, the quinquerimentiari. This commission was tasked with creating small banks around the forum and issuing loans at reasonable interest rates, offering a relief mechanism for those in debt. Impact of public banks? These public banks, established with the approval of the state, were designed to alleviate the economic burden on citizens, especially the poor. By allowing citizens to settle their debts through land and cattle, these banks helped to avert economic collapse. This marked the first recognition in Roman history that financial crises could destabilize society, and that the state had a role in mitigating these crises. Footnote: The quinquerimentiari was an early public banking initiative, created to mitigate the financial struggles of plebeians during times of debt. Private banks in ancient Rome, the emergence of argenturi. Private sector banking. By 318 BC, private banking emerged in Rome with the establishment of the argenturi, or silvermen. Initially functioning as money changers, they quickly expanded to offer more complex financial services, such as accepting deposits and providing loans. Their operations were modeled after the Greek trapezetes, reflecting the growing sophistication of Roman finance. Expansion of private banking services. Over time, the role of the argenturi grew, and they became the operators of full-scale banking institutions. These banks offered a variety of services, including managing accounts, offering lines of credit, underwriting sales, and arranging escrow contracts. The growing private banking sector reflected the increasing complexity of Roman financial systems as commerce and state involvement expanded. Footnote: The argenturi were the first private banks in Rome, evolving from simple money changers to full-service financial institutions. The role of debt and lending in Roman society. Debt and its impact on Roman society. For many Romans, access to banking services meant they could borrow money or exchange currency. However, borrowing often came at a steep price, especially for the lower classes. High-interest loans and pawning personal goods were common ways to access immediate funds, but these loans often came with dangerous consequences if repayments were missed. Debt was a constant source of social and political tension in early Rome, often resulting in political uprisings and demands for debt relief. Fiducia and collateral lending. In the case of smaller loans, debtors often had to hand over personal property as collateral under a system known as fiducia. This arrangement transferred ownership of the collateral to the lender, who could sell it if the borrower failed to repay. Such practices were used by poorer Romans who lacked the financial stability to engage in formal lending institutions. Footnote: Debt played a significant role in Roman society, with pawning and high-interest loans being common among the lower classes. Middle-class banking, expanding services and economic participation. Increased access to banking services. As Rome progressed, the middle class gained greater access to banking services. By the late Republic, urban residents could open bank accounts, deposit funds, and make payments. These services made it easier for individuals and businesses to engage in long-distance trade and commerce. Cross-border transactions and account management. One example of banking innovation was the ability for soldiers on the frontiers to send money home. Instead of physically transporting cash, soldiers could visit local banks, deposit money, and have it transferred to their families in Rome. This system allowed for greater economic mobility without the need for extensive fleets to carry physical cash. Footnote: Middle-class Romans had access to managed banking services that allowed for long-distance commerce and money transfers. Upper-class banking, formalized contracts and elite financial networks. The wealthy and banking services. For the wealthy elite, banking services were not just about managing money but also about safeguarding their wealth and ensuring the smooth transfer of assets. Elite bankers maintained detailed ledgers that served as legal proof of account balances and transactions. They also provided formal guarantees and legal contracts to protect their clients' interests. Elite financial practices and political influence. Banking in ancient Rome was deeply intertwined with politics, particularly for the senatorial class. Although senators were prohibited from direct commercial involvement, they used banking networks to lend large sums to cities, provinces, and even foreign monarchs, sometimes leveraging political influence and military pressure to ensure repayment. Footnote: The upper classes used banking systems to manage vast sums of wealth, often using financial instruments to exert political influence. The fall of Roman banking, from empire to fragmentation. Decline of the banking system. By the 3rd century AD, the stability of Rome's banking system began to erode. With imperial mismanagement and the ongoing crisis of the empire, many financial institutions either collapsed or became absorbed by local aristocratic and ecclesiastical structures. This signaled the end of the empire-wide banking system and the decentralization of economic life. Continuity in the Eastern Empire. Despite the fall of the Western Roman Empire, banking practices continued in the Eastern Empire, particularly within the Byzantine Empire. The integration of banking with the state and church allowed for the persistence of regulated financial practices, eventually forming the foundation for the medieval banking systems in Europe. Footnote: The fall of Roman banking marked the end of an empire-wide system, though banking continued to evolve in the Eastern Empire. Conclusion: Roman banking's legacy and influence on modern financial systems. Legacy of Roman banking. The Roman banking system was one of the earliest examples of financial regulation and institution building. While it faced challenges and ultimately fragmented, its legacy can be seen in the foundations of modern banking systems. Concepts like money exchanges, loans, credit, and banking networks all have their roots in ancient Roman practices. Influence on modern finance. The practices and ideas developed in ancient Rome would go on to shape medieval European banking, laying the groundwork for the modern financial systems we use today. The lessons learned from Rome's rise and fall continue to inform how financial institutions are regulated and structured. Footnote: The legacy of Roman banking laid the foundation for modern financial systems, influencing banking practices through history.